The whole idea about bad debt is that the debt is irredeemable. You can't redeem it, okay? Or the customers cannot settle or may not settle due to the reasons I've given you, like the death of the debtor or customer, the person runs mad, or has been declared bankrupt by a legal statute, or the debt is insignificant or immaterial. That is bad debt. Doubtful debt means that you are thinking they may not be able to pay due to some of these reasons. Okay. It is an expense to the business. So anytime there is bad debt, we put it in our profit and loss account as expense. Okay. In the balance sheet, you deduct it from the debtor's balance. However, you go through these two if you see the bad debt in the additional information. Take note of that. If it is in the additional information, then you take it to your profit and loss as expense, so under your expenses, okay, you put it there, bad debt, you put the amount there. And then in the balance sheet too, when you bring your debtors figure, you less the bad debt from it. However, there are some questions where you see bad debt in the trial balance. If you see it in the trial balance, please, you only take it to the profit and loss account as expense. It doesn't go to the balance sheet. So bad debt goes to the balance sheet if you see it in the additional information. The reason is that if you see it in the trial balance and there is no information in the additional information, it suggests to us that the bad debt has already been adjusted to the debtor's balance. I hope that makes sense. So let me put in an example here so that. So let's assume that maybe this question will have bad debt written off is maybe 150. So if you see this additional information, please, you go to your profit and loss account under your operating expenses, you put it in the bad debt. $150. And then when you come to the balance sheet, immediately you put in your debtors, you indicate less bad debt. So at that point, you can bring your debtors figure to the first column, and then you less the bad debt from it, 150. And whatever you get becomes the net debtors balance. There are questions too. The bad debt will be given in the trial balance. So let me put one in the trial balance. If you see bad debt in the trial balance and maybe there is no information about it in the additional information, I'm saying you only take it to your profit and loss account. Okay, you put the figure there. So let's assume here the bad debt was 200. So in your profit and loss account, you only take it as expense 200, and it doesn't go to the balance sheet. You don't less it from the debtors figure, right? There are some questions too. You see it in the trial balance, and again, you see it in the additional information. Please pay attention. I'm giving you all the angles from which this bad debt could be examined. If you see it in the trial balance and in the additional information, this is what you do. In your profit and loss account, make sure you take all the bad debts there. So by that I mean, pick the one in the trial balance and add on the one in the additional information. So it will be 200 plus 150. And that'll give you 350. But when you go to the balance sheet, you only less the amount in the additional information, 150. That's the point I'm making. So for your bad debt, you have to determine where it is before. If it's in the additional information, it goes to the profit and loss account as expense. It comes to the balance sheet to be deducted from the debtors figure. I hope that is clear. So that is on bad debt. it is an expense. Okay. Provision for bad debts. Provision for bad debt. We are saying that because every business assumes that maybe some of the customers will die, some of them may go mad, or they make provision, they provide for that particular incident. How do they do it? They do it by charging it against their profit. So let me use a scenario to make it more meaningful. You see, your father is aware that you go to school, and when you are going to school, he needs to provide for your chop box. So provision for chop box, if I may put it that way. So your father will pick out of his profit, in this case, I could say his salary, okay, and give you that money to take care of your provisions in your chop box. Okay. So let's assume, for instance, your father in the first semester gives you 1,000 Ghana cedi for provisions. I know that will not be the case. Your parent will not give you 1,000 cedis for anything. It will spoil you. That is just by the way. So if they give you 1,000 cedis, that is what you are going to use to spend for the semester. Now the focus is on your father. So your father will deduct that 1,000 cedis from his pocket or salary. In our perspective, we are going to look at the salary or pocket as the profit. So anytime you make that provision, you less it from your profit. And by that, I mean in the profit and loss account, it is treated as an expense. And then when you come to the balance sheet again, you less it from debtors fee. But the interesting aspect here is that sometimes you have to analyze and see whether you have to increase the provision or reduce the provision. So the scenario that I use, after the first semester, when you come home and your father realizes that, the 1,000 cedis he gave you, in fact, you are looking very lean because the money was not enough. Then the second semester, your father will think about increasing the amount from maybe 1,000 to say 1,500. Okay. If that happens, it means your father will have to go back to his profit again or his salary. So the first instance I'm giving is that sometimes you have to increase the provision. And if you are increasing the provision, you still need to go to your profit and loss account and less it. How do you do that? By adding it to your expenses. So under your operating expenses, you indicate increase in provision for bad debt. Again, when you go to the balance sheet, you less it from the debtors figure. The second scenario is where you have to decrease it. So this time you went home and your father sees that, the 1,000 cedis, you even have 700 cedis still in your pocket or your purse or your wallet. So your father will realize that, he made excess provision. So the second semester, he may decrease it from the 1,000 to say 500. If that happens, dear professors, would you agree with me that your father is saving 500? As a matter of fact, he is getting 500 additional back into his salary. Do you agree?
Yes, sir.
Okay. So that is to say that in the event that you have to decrease the provision, the decrease will not be an expense, but it will be a gain. Okay, so in that circumstance, you are going to add it to your gross profit. In the balance sheet, you still less from the debtors balance. So I've given you three analysis here. The first one is when you make the provision the first time. See, when you went to Form 1, your father will make the first chop money provision. So that one, there's nothing like increasing or decreasing. The increasing or decreasing comes in when subsequently, so the second semester, your father will now begin to compare your first semester and see that, oh, okay, I need to give her more or him more, or I have to decrease it. So in the first instant that you are creating it, you go to your profit and you less it. So you add it to your expenses. Now, subsequently, if you have to increase it, then we're saying that the increase is also going to be deducted or added to the expenses. You deduct it from profit or you add it as part of your expenses. But if you have to decrease it, then that decrease should be added to your gross profit as part of your other income. So please understand the scenarios from when you first create it, where you have to increase it and where you have to decrease it. If you understand it that way, I think we can make a huge progress. So let me hear from you if you're okay up to this point. If not, I would use another illustration or scenario to explain to you. So let me hear from you, Prof. Alessia, Sandra, and please, are we okay with the explanation so far? Okay. If you're okay, then what's next is for us to take illustrations, which will be possible in our next lesson. So let me wrap up on this bad debt and provision for bad debt. We have just agreed that bad debt simply means a debt that is deemed irrecoverable, or the debtors may not or cannot pay or settle. If you see bad debt in the additional information, you take it to your expenses in the profit and loss account. In the balance sheet, you less from debtors. Okay. I gave you the other scenarios. If it is only in the trial balance, you don't take it to the balance sheet. You only take it to your expenses because it's an expense. Provision for bad debt. We say some businesses make provision against debt that may deem irrecoverable. Okay. So we can have the point where they have to increase it or the point where they have to decrease it. If they have to increase it, then that increase will be part of their expenses. But if they have to decrease it, then that decrease will be added to the other income or the gross profit. This is a summary that I want you to remember. Finally, in the balance sheet, both bad debt and provision for bad debt are deducted from the debtors' balance. If we are okay, professors, then I would end this lesson. And next week I'll bring an illustration where we have all these adjustments in there so that we solve. I would love to solve about 4 or 5 illustrations so that we get comfortable, and then I'll leave you to your fate. So if there's any comment for me, any question, confusion, please bring it on board. And if you didn't understand, don't worry, I'll share the video. If you watch and still you don't understand, in our next lesson, we'll touch on it again. Okay. So final comments from my professors. If there is none, then I would honorably sign off. Take good care of yourselves. Expect some assignments and exercises as well, because you have a lot of days between now and next week.